I'm speaking to David Lloyd, co-head of emerging companies and portfolio manager at Ausbil Investment Management. David, first of all, thank you for attending and participating in the Inside Network's Investment Leaders Forum, Queenstown.
Well, James, thank you for having me. It's a pleasure to be here.
Yes, it's a beautiful place and some interesting conversations. First up, David, what drew you towards Australian mid-caps? And what makes that segment of the market, from your point of view, uniquely compelling for long-term value creation?
Yeah, sure. Thanks, James. Look, I was drawn into mid-caps because I think it's just it's like an explosive part of the market, but it's ever-changing as well. You could argue that the top 50 is a little bit boring, full of large banks and a few large resource companies, and that might be pretty close to the mark. But and then small caps can really get a little bit flaky and a little bit fluky for me. So you've got proven businesses, those that are coming up from small caps into mids. Huge diversity of companies on offer in that mid-cap space as well. Companies always growing in and through the index, and companies coming down and changing their stripes a little bit. So I think it's an evolving part of the market and full of really good opportunities, I think, because you get those fallen angels that are trying to change their trajectory for the better, but also you get those exciting companies that are coming through from smalls into mids, and those could be the Pro Medicuses of the world, or the WiseTechs, the car sales, the REAs, the hubs, the net wealths. I mean, there's so many of them, and they're all exciting. They're all growing really quickly.
Parameters are important when you consider smalls and mids, etc. So take me through what Ausbil, where does smalls cut out for you, and where do mids begin?
Yeah, so mids, let's start at the large end and work my way down. So mids start at, let's call it the 51st largest market cap company. Depending on their free float, they could be $15 billion in size. So these are relatively large companies. And then the mid cap finishes at around stock 99, 100, obviously. And market cap's probably tailing off around $3 or $2 billion at that level. So these are well capitalised companies in mids. And then the X100 space, and then the X200. So, in the emerging leaders capability at Ausbil, I can play in the X200 space. If there's a shooting star that we think is coming through, a new IPO that's out of index, for example, we can certainly take advantage of those stories and stocks that are coming through. But we are aware of our risk parameters as well when we're managing these portfolios. So you do manage the size of those positions accordingly. So if they're a little less liquid, for example, that will have an impact on our positioning.
You alluded to this earlier, David. The mid-cap universe sits between the scale of the big companies and a bit of comfort in that, and the dynamism of micro-caps and larger small caps as they move up towards mid-cap status. So how do you navigate that opportunity set? You might be excited about the story, but in the Australian market, you've got to be so conscious of monitoring the risk that they can get taken out the back and shot with an earnings downgrade that the market didn't expect.
Yeah, that's absolutely right. You can see some savage moves, and August is a minefield, particularly where they're delivering results now. But how do we navigate that? Well, firstly, our process, top-down, bottom-up. The top-down's important, but it's probably more important for the larger cap companies. So it's really the bottom-up that we have to focus on the smaller micro-cap companies. And that's really getting into the weeds and understanding the key drivers of the business, understanding the industry that they work in, and try to manage those risks or those risk factors that we could see potentially on the horizon or otherwise. At Ausbil, our mid-cap capability, one of the greatest strengths is that we do have a good line of sight on those mid-caps of tomorrow through our small cap and micro cap capability. So often the team is identifying these companies from a long way down the market cap spectrum. They typically graduate from the micro cap into the small cap. And once that transition starts to happen, that's really a trigger for myself to start looking at, well, could that be the next mid-cap of tomorrow, if you like, and come right through? So we get to know these companies early, engage a lot with management in the micro-cap space, and also just our process and the top-down, bottom-up hopes to try to negate some of those blow-up risks, if you like, in that space.
As a journalist, David, I've written about a lot of Australian companies for many, many years, often off camera or with the microphone not on. I've spoken to managers. We've talked about, what do you think of this company or that company, and It's always struck me how managers will say, "Yeah, I really like it, but it's a bit too small at the moment," and effectively, I'm thinking they're saying, "Well, we're not going to own it until it costs more."
Yeah.
It's a strange mentality, but they have to be, I suppose, from your point of view. You've got to be so rigorous and stick to your parameters.
You do, but like I try not to let that be an excuse. Liquidity is a factor that we do look towards. But, we can get some of these smaller cap companies into the portfolio. We just have to size the position appropriately so that if things do go wrong, we can manage that from a risk perspective in the portfolio. But there have been plenty of occasions when we've put X200 names into the emerging leaders capability or portfolio because we do see that growth pathway. And we all want to be on the next Pro Medicus, well before it gets to the 100. I don't want to be buying it when it's completely proven and it's trading on $1 gazillion, if you like. So, that's the challenge, but there is room in the portfolio. Just have to be sized appropriately.
In a firm like yours, is there a handover from, say, the microcap people when something grows out of their parameters and up into yours? Yeah,
well, we sit together in the emerging companies pod, if you like. There's 5 of us in that team. We all sit next to each other, essentially. So the discussions are ongoing every single day around, how about this company coming through? And I'll often have a list of companies that are coming through that I think are the ones in conjunction with the portfolio managers for the small and microcap team. Let's call it like a watch list, if you like, of stocks to come through. So that sort of handover or transitionary period is always, it's almost like ongoing every single day. So when we see that there are some certain catalysts emerging, or perhaps there's an equity raising that allows me to participate, that process is already well underway. So there's not like just a point in time where this now becomes your stock. You need to get up to speed. Here's the booklet and the PowerPoint presentation. That's happened many months beforehand.
I think one of the really underappreciated elements of the Australian share market is there's a lot of headlines and everyone will read about it and have some knowledge of it about concentration, and the ASX has got difficulties with that. But I don't think a lot of investors appreciate that you are looking at a completely different share market in terms of sectors, industries, exposures, geographies even.
Yeah, I think it's a really interesting point that you bring up around mid-caps versus, let's call it the ASX 200. I think probably the best statistic I can put back to you around that is just the banks. Banks' market capitalisation comprise 25% of the ASX 200, comprises 2.5% of my index. So I don't have to have capital tied up in a sector that I might not want to be in just to protect my positioning and tracking error against the benchmark, if you like. So it is a very diverse universe. It enables those faster growing companies to have more impact on performance. So it's night and day really, the composition, I think, largely driven by that banking weighting being significantly lower.
And you talked in your presentation about resources. Can you get involved in companies that are not yet at production, but you get quite confident in the ore body and the offtakes or whatever that you think is going to in the future make them a profitable producer?
Yes, we can, and we do have one such company in the portfolio. So as a house, we're very bullish on the outlook for uranium. We really think the supply-demand dynamics is such that it should result in higher prices going forward. We do have a position in Emerging Leaders Fund in NextGen. It's a huge resource in Canada. They're on track to be the lowest cost producer in the world, bar none. And even at current prices, we think this thing's going to spit off enormous amounts of free cash. Still going through the final stages of let's call it approvals, but we expect those to be obtained no later than February of next year. Clearly, we then move into phased construction process, which does present some risks, but we're well aware of that. We do think funding's in place, and then production, and then turning to, let's call it revenue, should happen in the early 2030s. So yes, we do, but again, NextGen's not the biggest position in the portfolio. It's weighted appropriately.
A lot of the mid caps that are in your world aren't represented in the broader indices that a lot of Australians follow. So is it a task to try to convince advisors that they could and should play a role in portfolio construction?
I think it's flown under the radar and I'm not sure that let's call it the mid-cap market, if you like, has really sold itself well enough. I think the market's caught between, I'll just buy my large cap equities and then I'll have the fast-growing small and micro caps, whereas that middle ground just seems to get lost in the discussion a little bit. But I think, we've gone through a heck of a lot of macro changes in the last 5 years, and I think this could ultimately be one of the great calling cards for the sector, in that we've gone through a pandemic, inflationary periods, massive interest rate increases. We've gone through government changeovers, Middle East conflict, European conflict, tariffs, and the sector's performed outstandingly well against that backdrop. So it really highlights the resilience of the sector, its ability to grow through all these pressure points. So I think it can give you that large cap sort of safety, if you like, with growth, whereas we just haven't seen that same level of performance in small caps. And looking forward, our view is that banking earnings growth is likely to be pretty muted and sort of put the brakes on that performance from the large cap end of the market. So I think there's a real refresh to be done on mid caps, and I think the outlook is really exciting from here.
And as you mentioned, the next car sales, the next Pro Medicus, the next REA, they are there.
They're there. Look, we think 360 could be the next one. We think it's almost at that inflection point where it's got 80 million monthly active users around the world. I mean, it's enormous. And one great statistic I'll leave you with is that 15% of the US population has Life 360 on their phone. 1 in 7 mobile phones in the US has Life 360. In Europe, the penetration rate's 2% versus the 15%. So we can still see a long runway of growth for some of these companies, and Life 360 could hopefully be the next one of those.
There you go. Viewers, 360 is the code. No recommendations are being made in this interview, David. But David Lloyd from Ausbil, thank you very much for your participation. It's been great talking to you.
James, thanks very much for having me. Thank you.